my honor to introduce our next panelist. And of course, I will introduce one of my admirers, Dr. Mark Mobius, for coming up to the stage. Being an investment professional for the last 20 years, Mark Mobius is a star. Really, I think he needs no introduction in Hong Kong because he has a nickname, the godfather of emerging market investment. So that's it already summarized up of Dr. Mobius. But I still want to highlight a few achievements. During his time being, the chairman of Franklin Templeton, over the last 30 years, he had grew a company with, 500 million in emerging market assets to 50 billion, assets. And Dr. Mobius was recently, also established Mobius Capital, founded Mobius Capital, focused on, Latin America, Africa, Eastern Europe, for, ESG standards in emerging and frontier market companies. Well, he was also asked to serve on the World Bank's Global Corporate Governance Forum and a member of, Economic Advisory Board of IFC, International Financial Corporation. Mark received his Lifetime Achievement Award and also Global Investor 50 Most Influential People from Bloomberg Markets magazine. Of course, you are also a frequent traveler and also a very dedicated and diligent writer, author. He has co-authored a dozen books. Actually, he brought his most recent book to our GEF Hong Kong. We're honored and glad to have his book to be autographed later by Dr. Mobius. The book is The Inflation Myth, and the wonderful word of deflation, the D word. Yeah. So welcome back to Hong Kong, Dr. Mobius, and I certainly hope there are no more issue of your wealth coming out of China by now. Just a joke. Thank you.
It's great being back in here in Hong Kong because it's been a while. It's been about 3 years since I've been in Hong Kong.
Yeah.
Thank you.
So enjoy Hong Kong.
Good to see you.
Yeah.
Thank you.
Thank you. And may I also invite my friend, anchor of Bloomberg, thank you, David Ingles, to join us and bring to us another amazing interview, actually, of Dr. Mobius.
We'll try. We'll try. Hi, good afternoon, everyone. Mark, nice to see you. So whenever Mark comes, I'm David, by the way, from Bloomberg TV. Whenever Mark comes on the show, we always have an issue because our interviews are 6 minutes max. And when we talk to Mark, literally covers in emerging markets, everything, right? So you can imagine just the dilemma we have of fitting 4 questions to talk about what you do. Well, let me just get started by asking you, why have emerging markets stopped emerging? Like the index is just, it hasn't gone anywhere.
If you look at the last 3 years or so, until recently, by the way, emerging markets are now outperforming the U.S. S&P 500. But if you look at the last 3 or 4 years, they've been underperforming. And that's mainly because if you take the index, it's 30% China. And if China's going down, the index is going to go down. So that's the real problem. But if you separate China, then you'll see outperformance, mainly because India and some of these other countries are growing very fast. But when you look back, and when we started in 1987, we had only 6 markets in which to invest. 5 of those were here in Asia, 1 of them in Latin America, Mexico. Think about what we are now. We're 70 countries around the world where we can invest. And China is huge. India was very much closed when we started. So this is a big change that's taken place.
Yeah. Well, hence the earlier dilemma, 70 countries in 6 minutes to talk to you about. To your point, do we need to stop lumping them all into an EM basket? Because anytime you buy the index, to your point, so I was checking right before I came here, the EM index has virtually underperformed every year since the GFC, with the exception, I think, of one or two, the S&P 500.
Yeah, exactly. That's why I tell people don't buy the index. Try to do individual country selection and, more importantly, individual stock selection. Because at the end of the day, it's the stocks that are going to determine the behavior of the market. And if you do good stock selection, particularly in emerging markets, you're going to do very well. Why? Because emerging markets are growing. Still, they're growing at double the rate of developed countries in terms of GDP growth. So naturally, as a rule of thumb, if a country is growing at, let's say India is now growing at 7% in real terms, the earnings per share growth in companies will be double, about 14, 15%. So it's a no-brainer for you to pick stocks, in individual stocks, in emerging markets.
Yeah, well, since you brought it up, I mean, that market, India, cannot stop rallying. I mean, it's double the price of China. I think we're trading at 21 times. China's at 10. Yes. The index guys would know here at HKX. But that keeps going up, and you've been bullish in India for the longest time. So why have you been bullish for the longest time, and what's changed recently?
Well, first of all, look at the fundamentals of India. Okay, growth 7%, but why is India growing at that rate? Young population. Average age in India is 26. China, 36, 37. That's number one. Number two, digitization has taken India by storm. You know, they've had an incredible gains in digitization, just like the identity card system that they have. That's all digitized. So it's an amazing development you have in a country of 1.4 billion people. It's really going to be very exciting going forward. It doesn't mean the market is going to continue to go up, straight up. You're going to have corrections along the way. You're going to have problems, you know, with individual companies. But generally speaking, you've got to be in India. That's why I agree with the previous speaker when they were talking about, you know, the fast-growing countries. Where they're going to go is India and Indonesia.
What do you own in India now?
Now we are owning software companies. We own companies that do hardware, I mean construction materials. A company called APL Apollo is doing tubing. We do healthcare, companies that are doing measurement of healthcare. So it's the great thing about a market with 1.4 billion people is that you can pick any industry. They're doing everything. You know, you can do consumer, you can do finance or whatever.
Right. And we were talking in the green room about this too, you know, the importance of, you know, structural reform. You know, first, it's a topic I hate to talk about on TV because it's so up in the clouds, and you realize the benefits, to your point, of structural reforms 10, 20, 30 years down the road. Is that what's happening now in India, you feel?
Yes, exactly. You see privatization programs moving ahead. You must remember, under the previous administration, the Congress Party, they were very much in favor of state control. Now, under Modi, they're moving more and more towards privatization of state-owned enterprises. It takes time, obviously, but it's moving ahead. Air India is one good example. I don't know how many new planes they've ordered as a result of the privatization of that company. So you're seeing that happening. And one of the things that we must keep in mind is that the tremendous boom that we've had in emerging markets has come about because of the market economy adoption. You know, the World Bank, the IFC, these multilateral institutions realized, it was way back in 1987, even before that, they realized that in order for a country to grow, you've got to have a market economy. That means stock markets, obviously, and privatization of state-owned enterprises. China is where it is today because of that. If you look at the tremendous growth that China has achieved, it's because of privatization and allowing the free market to move ahead.
Right. And to your point, because of, when you say that, what is that? Because of what Deng did in the early 80s. Okay, if you could expound on that too.
When Deng Xiaoping said, look, I don't care if the cat is black or white as long as he catches the mouse, That is what it's all about. It's allowing people the ability to do their own businesses freely. Of course, within a framework, the state has got to supply some framework, but otherwise, the privatization program and the market economy is really what drives an economy.
The story of China's, I guess in many ways, not completely gone away the last 2-3 years. You know, the premium in that market remains, whether that's because of this recovery that's quite slow or remnants of the regulatory tightening that they've done around tech, for example, and now you have geopolitics to contend with. When do you think this market gets out of this sort of vicious cycle and emerges again?
Well, despite the tensions that you have with the U.S., despite the problems they've had with Alibaba, Tencent, to give examples, and the tighter government control, despite all that, the fact remains is that there are an incredible number of enterprises in China who are free to do their business and are doing tremendous work, not only in China, but globally. I mean, as I travel around the world, I go to Africa, I go to Latin America and so forth, Chinese companies are very much there, and in America as well. You must remember the investments by Chinese companies in America are very substantial. So we cannot ignore China, that's for sure. But as I said, you've got to use a rifle instead of a shotgun. You've got to look at precisely which companies are going to be the best in which to invest, which ones have the characteristics that we look for when we're looking for good companies.
Right. To your point, it's I forget what it's saying is something along the lines of China's now too cheap to short, too large to ignore, but too risky to invest in.
I wouldn't say too risky to invest in because...
Well, I'm pushing the extreme version of that concept, but yeah.
No, but I think your point is very well taken. If you look at institutional investors in America, as you know, many of them have said, no China.
Is that still the case?
Yeah, it's still the case. A lot of people are afraid of China. In fact,
what's the counter argument to that? What do you tell them when you hear that?
The counter argument is that, hey, how can you ignore China? It's one of the largest countries in the world. The population is not 1 billion, it's maybe 900 million, 850 million, but still, it's a rising per capita income country and got incredible companies. So you can't ignore it. It's kind of throwing the baby out with the bathwater. You can make these general decisions regarding strategy, et cetera, but I think it's a big mistake to ignore China.
So what are you guys doing in China now? What do you own? What are you busy looking at, mulling?
We're looking at companies that are focused on the consumer. So, for example, we have a company that's actually here in Hong Kong that does beauty treatments and that sort of thing, because there's a rising, of course, middle income people who are paying more attention to how they look, beautification, that sort of thing. So that's what we're focusing on.
Yeah, you can't go long with vanity, right? Long on vanity?
Exactly.
No. Well, we had a really good conversation in the green room earlier. I'd like to share that with the viewers. Sorry, my language is still in studio mode, sorry. So you mentioned to me PE multiples. That's not the metric you use to value stocks.
Exactly.
Like that you don't even look at PEs now to pick stocks.
Yeah, it's really interesting because when we were at Franklin Templeton, we Graham and Dodd, Warren Buffett, they're the mentors. And John Templeton, my mentor, always looked at PE, price to book, not exclusively, but that was sort of the measure. So if a company had a low PE, they say, hey, that's a bargain. No more. From my point of view, that's not, you don't want to be looking at PEs. Because PEs are a backward-looking measure, because you're looking at the earnings currently and backward. Okay, you're doing projections, but how do you project the earnings of a company? So what we're doing now is saying, okay, forget about PE. Let's look at return on capital, return on equity, because that measure is very difficult to be changed from one year to the next, because the nature of a business is very much reflected in the return on capital. So if you have for example, our criteria is that a return on capital of at least 20%, more often than not, you have a company with that characteristic, they have no debt or very little debt. So the next characteristic we look at is debt equity of less than 50%. Very easy if you have a ROE of 20% or more. And then earnings growth is there as well. So we look for at least 10% earnings growth. So those three characteristics, and of course, we need liquidity. We're running open-ended funds, so we need at least $1 million turnover per day. So we've found that those really worked well for us, those criteria.
That's for people that live in Hong Kong, just using that criteria is almost when you tell the property agent, I want a big apartment with a large terrace under this price with 5 bedrooms. Well, the reason I bring that up is with that criteria, aren't you almost shrinking your possibilities? Like how large is that pool of stocks that meets all of those simultaneously?
Very difficult to find, very difficult. In fact, we just did a scan of the Hong Kong market. We found 4 companies that met that criteria.
Only 4?
Only four that meet those criteria.
Out of all the stocks listed on this exchange where we are right now?
Exactly, yeah.
Okay.
So very difficult to find. And then, of course, that's the first step. You know, we find companies with those characteristics. Then we go visit the company, find out what the ESG, you know, we look at ESG, environmental, social, and governance in terms of risk control. So then we look at those characteristics, and we've added C, culture within the company. So, you know, once you go through that process, then you can eliminate some other companies along the way.
Right. So out of the 4,
maybe get one. Or
we get 1? Okay. Do you own any of that?
Yeah, we own one.
You own 1, okay. The one that met the C, I guess, right? Okay, well, talk to us then about other markets. You're excited about Taiwan and Korea.
Yeah, you know, our biggest holdings now are Taiwan, Korea,
Okay.
and India. Those are the 3 big, right?
Biggest parts of your pie.
Yeah.
Okay.
But we also have investments in Kenya. You know, we're talking about fintech. M-Pesa, the company Safaricom, has this money transfer system in Kenya, which is incredible. South Africa, Brazil, Turkey, Vietnam. So we're in those countries. But again, it's because of stock selection. You know, a lot of people say, hey, Turkey's got 80% inflation, the devaluation of the Turkish lira, so forth, so on. We still find a company that has incredible characteristics. Why? Because they're exporting in dollars and they're paying in Turkish lira. So the margins, return on capital, is incredible. So that's the kind of thing we can, even in countries that may have a very bad macro environment, very often they're good opportunities, with one exception. If a country says we're going to take over companies, get out. We get out. So when we were many years ago, we were in Venezuela, and when General Chavez came in, said we're going to take over companies, we were out of there.
Right.
In a flash.
I guess it depends on the price they're taking it over, though. If they're buying it at a premium.
They never buy them at a premium.
Oh, okay, well, that's the other
In fact,
point.
it was interesting because we had a big holding in a company called Electricidad de Caracas, the electricity company in the capital city. And we sold it to another American company, and we couldn't figure out what they were doing, but I think 4 or 5 years later, they sold it at half the price they paid, you know, because the government was taking over.
Side point, you mentioned Turkey. It brings to mind, how do you manage your currency risk?
What we do is just, you know, currency is so important to so many people, and they're exactly right, because we're investing either in US dollars or British pounds mainly. So what we do is we say, to try to hedge a currency for an investor like us who holds a company for an average of 5 years, it would be too expensive. So what we do is we do a natural hedge, just like the example I just gave you. A company in Turkey doing software, they're taking advantage of the devaluation of the currency. So the more the currency is devalued is great for the company. It's a positive. That's what we call a natural hedge.
Okay, because they earn in dollars, this specific
They're
case.
earning in dollars, yeah.
Is that the same criteria that you use when you look at some of these names in Korea, for example, and Taiwan?
Exactly. It depends on the currency, of course. If you look at Taiwan, Hong Kong, currency is tied to the U.S. dollar, more or less. And their central bank are pretty careful about, expenditures. The same thing in Korea. But still, we have to look at, currency devaluation. I mean, 5-10% one way or the other is not going to be a big deal. But when it gets like in Turkey, you really got to worry about it.
What do you own in Taiwan?
In Taiwan, we've focused on the fabless companies, the companies that are doing the design of the semiconductors. As you know, TSMC is a giant, and there's so many satellite companies that do the design for the chips that TSMC produces. And these companies are very profitable, and their assets really are people. They have no factory.
And in Korea, what do you own?
In Korea, the same thing. We're focusing on high-tech companies. For example, we recently purchased a company that's doing high-powered microscopes for use in the semiconductor industry. Because now, as you get down to the nanometers surface of these semiconductors, you've got to have a microscope to detect errors and flaws. So that's a company we've just invested in.
It just dawned on me. Is this also how you play AI, for example? Are you thinking about AI at this point?
AI is really an amazing development, as you know, and that's going to be having an incredible impact. But a lot of people, sort of consider AI as something out in the atmosphere, something distant. But AI is already with us. And what is AI? AI is actually a highly speeding up of semiconductors. And one of the reasons why we're focused on semiconductors is because in AI, you're going to need more and more powerful semiconductors. Because with AI, you're basically speeding up the ability to calculate and to communicate.
It's something that comes up regularly, that has come up regularly on our shows, is sort of this geopolitical strategic rivalry between the two, U.S. and China. And it's almost like countries and funds are forced to almost have two strategies. You have a U.S. strategy, you have a China strategy. There's a parallel AI industry that's emerging in China, a very, very good one. There's a separate one in the U.S. And I'm wondering, is that something that you're looking into, for example? Almost as a thematic that's divorced from credit cycles and business cycles.
Yeah, it's really a very good development in my view. Because, up to now, it's been the U.S. who have sort of dominated the design and downstream manufacturing of semiconductors. And of course, China, through Taiwan, has been using that technology. Now, China will be forced to develop their own technology. And that's great for us consumers, because you're going to now have two giants trying to produce semiconductors. They may go in completely different directions, which would be beneficial for the public, the consumer like us. So it's going to be interesting the way how China develops going forward.
Right. Trying to outdo each other. By the way, I forgot to mention, if anyone has any questions at this point, say your piece. Nothing yet. We'll leave some time at the end of the panel, so just in case you have any questions, of course, the microphones are around. Let's talk a little bit more about just the stock selection criteria that you use in China. I mean,
one of the things we've learned over the years, after making so many mistakes.
What was the biggest one? I'm curious.
The biggest mistake. How many hours do you have?
That big?
No, I remember one in Brazil, a company called Mesbla, which was a big department store in Brazil. And we were investing for many years in this company. We were doing fairly well, low PE, which is not a good. And, we'd go to, the main store was in Rio de Janeiro, and we had an office in Rio. And I'd visit the finance director and get the numbers that look very good. Everything is fine. All of a sudden, hey, the assets are missing. The assets are gone. Stock price plummeted. What happened? Well, the mistake we made is we didn't understand the company holders, the people that controlled the company, a family, actually a French family, controlled the company, and they had been taking assets out of the country. We lost an incredible amount of money from this incident, but interestingly enough, we hired lawyers, we tried to do something to get money back, and then finally, when I was in Rio, the SEC is located in Rio de Janeiro. It's called the CVM in Brazil. We went there and said, look, we want to talk to a director of the SEC, the CVM. And the secretary there said, sure, I'll get you one of the directors. Who walks out? The former finance director of Mesbla. This is what you have. So that was an example where, we really lost money. But there are many, many examples I could give you of where we've made mistakes. And mainly it's because we didn't pay attention to the management of the company. Who were the people running the company? What's their background, et cetera. This is the reason why I spend so much time traveling, because I go to visit companies and get a feel for the atmosphere in the company. I just came back from Delhi in India. We visited one of our holdings, and it was really interesting for me to meet not only the chairman, but his son. And I could sort of assess, it's a family sort of oriented company, I can assess, this guy really interested in the company, et cetera, et cetera. So you get these feelings as you travel.
Well, it's you bring up a very good point. It's access to information, really, that it's difficult, especially with what you do. I mean, emerging markets, to begin with, right? There's almost an information asymmetry between dollar investors and, to the level that you invest. Do you ever invest in a company without meeting management first?
No.
Is that a precursor almost?
Yeah, now we always meet the management. Mainly because we are paying attention to the governance, ESG, of course, but the G, because we want to know how they're going to treat us. And whether, for example, we go into a company and we say, look, how many independent directors do you have? Because very often it's a family company. If no independent directors, we say, you've got to have an independent director. And hopefully a female director. So many of these companies are very amenable to our suggestion, and we recommend directors for them. Many of these companies also don't have an IR, investor relations department. We say, look, you got to have you want your stock price to go up, you got to have an IR department, that sort of thing. So we work with them. And over the years, there's one incident we had in Turkey with Turkish Airlines. When we first invested in Turkish Airlines, it was, state-owned, kind of not too good. In fact, I remember the service was so bad. The call letters of Turkish Airlines, THY, and we always said that means they hate you. Because, it was so bad. And we went to the managing director who said, look, we recommend you have an independent director because you have all these government people on the board. And he said, I can't make the decision. You got to go to Ankara and talk to the minister. We went to Ankara. We talked to the minister. He was the guy that he looked like he came right off the farm because Erdogan had just come in and he brought all these people from the countryside. And I said, sir, we'd like to recommend you have an independent director on Turkish Airlines. He said, why only one? Why not two? And since then, if any of you have traveled on Turkish Airlines, it's really an incredible airline. And by the way, the other thing we did is that we knew in Vienna there was a wonderful restaurant. If you're ever in Vienna, there's a restaurant called Dough & Co. It's one of the best restaurants in Vienna, owned by a Turkish guy. And we introduced him to Turkish Airlines. And if you fly Turkish Airlines now, the catering done by them is incredible.
Okay. I think we've strayed a little bit away from the theme here. Restaurants in Vienna. Well, so it reminded me of, so I went to school in Shanghai. In fact, my former dean, John Quelch, was just on the stage. And I remember when I was going to school there, I'm not going to give it away, when, a lot of the issues back then were, to your point, governance issues around Chinese companies listed in the U.S., assets disappearing, short seller reports, that sort of. Since then, governance has improved tremendously in China. So my question to you is, when you speak to people in the U.S., what are the misconceptions still that you hear that you think should go away when it comes to just this mindset and approach of looking at this Chinese market?
I think the misconception mainly is about the lack of understanding of the incredible variety of China and the incredible differences within China. Because if you go from one province to another, by the way, same thing with India. I call it the United States of India. Some of these provinces are so different language and so forth. Many people in America don't understand that. They don't understand that you go from Guangdong to Shanghai and you got a different language. So that's one thing. The other thing is that they often think of the mindset in China is in one direction only. And and I know that's not the case. There are many, many differences of opinion. Sure, you may have a very strong central government, but still within this incredible, huge country, there are lots of differences. And you got to take that into account.
Okay, we have time for one question. If there's any question out there, just one question from the audience. For Mark? Anything else? Okay, well, thank you so much, Mark, for your time.
Thank you.
30 minutes went by fairly quickly, and apologies if parts of that conversation sort of strayed away. Mark and I agreed not to sort of have a script, and just hopefully you enjoyed all of that. Of course, we'll be around for any other questions. Thank you so much.
Thank you.